So this I consider as kind of like your foundation, your strong core. So now we get to have a little more fun. We can start saving for big ticket items. Retirement is probably the most expensive thing you're going to have to save for, right? You might work for 30 or 40 years to then retire for 30 or 40 years. So you're going to have to make sure you save enough to provide that income for you on the back end. There's a lot of good options here. Matching on the 401k is something I see a lot for clients that they're not taking advantage of. I know it sounds like a no-brainer. People just sometimes get busy and don't look at it. So what's typically going to happen is if you're at Google, every dollar you put in that 401k, they'll give you 50 cents. So you put in $18,000, which is your maximum for the year, they'll give you $9,000. You just got a $9,000 raise by putting your money in the 401k. Worst case scenario, something hits the fan, I'll get you in a sec for sure. Yeah, something hits the fan, you need the money, you still come out ahead, even if you have to withdraw the money out of the 401k and pay a 10% penalty. What's bigger, a 50% match or a 10% penalty? You're still ahead. So it's kind of thinking in terms of where can I get the most bang for my buck? Yeah?
So saying for graduate students are not eligible for 401ks?
I don't think so. I don't think so. Most of you are not. You're getting stipends or other type of income. That's right. So this will be once you get that next gig. Yep. The next gig, which may be a while, I know. Yeah? Yes. Now we're to the next one. My favorite thing, I refer to it for clients as magical unicorn money, is a Roth IRA. So if you've heard, yep.
If you were on a fellowship from the government.
Oh, you beat me to the punch. I was going to sound so smart. Go ahead. Yeah. That's right. So Roth IRA and retirement accounts have to be based on earned income, wages. And so there's this weird thing where it's the stipend and the type of income you may get as a grad student may not qualify. So in order for you to fund a Roth, it may have to come from other side gigs that you're doing during the summer or other income that's going to come out to you on a W-2 or a 1099 basis. So you got to make sure it's earned income. But I love me some Roth. And so here's an example. So you said mid-20s. So let's say 25 for ease of thing. So you can put in $5,500 is the maximum you could put in. You have to earn at least $5,500 to put in $5,500. But let's say you did that this year and then you never did it again. Well, I would love to say that I could get 12% per year for my clients. That would be great. But let's say you go to Vanguard and you choose a low-cost index fund. And let's say that low-cost index fund gives you about a 7% return. There's a thing called the rule of 72. If you take your interest rate, divide it into 72, that's how many years it takes your money to double. So if I'm getting a 7% return on my index fund, 7 into 72, it's about 10 years. Every 10 years, my money's going to double. So if I'm 25 and I put in $5,500, by the time I'm 35, having put in nothing more, it may be 11. And then by the time I'm 45, it may be 22. And then by the time I'm 55, it's at 44. And by the time I'm 65, it's at 88. If you didn't do the Roth, if you just put the $5,500 in a normal index fund, a normal taxable account, you're going to have to pay taxes on the difference between what it's worth and what you put in, plus you kind of accumulate some interest there too. But basically the difference between these you're going to have to pay capital gains on. So if the difference is about 80 grand of growth, you might owe 20 or 30 grand in taxes when you pull that out. You put it in the Roth, 88 is 88. There's no taxes. So for every 1 year of saving $5,500 in here as a 25-year-old, you might save yourself 20 or 30 grand in taxes on the back end when you actually touch it. Magical unicorn money. It's pretty sweet. So these are some of the things to think about that you could take advantage of, but very good point. You may not be able to. So you just got to be you got to do a little more research on there. Maybe your board of advisors could help you as you start working with a CPA, get some advice on it. Yeah, go ahead. Oh, if you just invested it so a Roth IRA is just a label that goes on the investment account. It says the government's going to give you some of these tax benefits in exchange for saying I'm not going to touch it till retirement. If you just invested in a normal account that you could touch anytime, like tomorrow or 5 years from now or at any point, it could still be invested in the same kind of thing, like the same kind of mutual fund, but you're going to have to pay on the gains. Whatever it grows, you'll have to pay taxes on whatever the growth is when you pull it out. So the difference is you might have the same investment. It may be the same mutual fund going up by the same rate of return. If it's inside a Roth, which has these limits about how much you can put in per year and things like that, you're going to get tax-free growth if you touch it in retirement. If you have it in other places, you're going to have to pay taxes. So it doesn't mean the Roth's always best, because you're also kissing some money off for the long run, right? So once again, it's a balancing act between these things to think about where's the best thing. But in general, if you can do a Roth now, those are the clients that are so far ahead. They're at that stage in 35, 40 where they're doing a down payment. If they have to scale back some of their retirement savings to get into a house, the money that's already at work from 10 years prior is making up the difference for them. Yeah. Go ahead. Question, sorry.
So if we started a Roth now,
Yeah. Yeah. Yep. You got them both. Your balance sheet gets more complicated. You get more line items. Yep. So you might do the Roth. You also get termed out of doing a Roth after you earn a certain amount of income. So once you make over about 120 as an individual, you can't do a Roth anymore. There's a weird loophole right now where you can, but that may not last. And anyway, so once again, this is where you get into the tax person help. But what I would say is just think of it this way. I do a Roth now. I'm going to do it as long as TurboTax tells me I can. And then I may also be doing my 401k and matching once I get out of here. Yeah. Do both at the same time. They're not mutually exclusive by any means. They don't offset. Yeah. I think you had your hand up, or yeah. Sort of. They have an inflation-adjusted number, $5,500 right now if you're under the age of 50. Kicks up by, they let you do a catch-up of another grand on top of that if you're over age 50. So it's, and it kicks up every few years. They kick it up from, like it used to be $4,000 when I graduated from college. Yeah. And I'll do one more on this and then I'll finish this. Yeah.
So I'm a foreigner, so none
Yeah.
of these are relevant to me.
It depends on where. This also gets complicated. I have a lot of clients who are not born here or who may not be citizens here or who may not plan to be here when they retire. It depends on the country and the tax treaties. Some countries have tax treaties where they respect the tax-deferred or tax-free growth in these accounts in the same way if you're there or here, depending on how it's set up. So it does depend. There's no blanket statement for it, but it doesn't mean you shouldn't be thinking about it. Yeah, one more.
If you want to start a Roth IRA, how do you do that?
So that's a great question. So you can go to a financial advisor where you had the setup where it's either the assets under management fee per year or the brokerage fee, or there are online brokerage fees where they've essentially automated out the advisor. So a good example is Vanguard was one of the first companies to kind of do DIY investing, low-cost funds, things like that. That's a great place to do some research. I don't want to recommend necessarily any one platform is better than others, but other big names like Schwab, who's going to be doing some of the investing courses here, they have a great online platform. Fidelity. There's a lot of ones out there. There's also these new robo-advisors that you may have heard of called Wealthfront or Betterment, Personal Capital. Those are gaining a lot of traction. Is also trying to take away some of the how do I put it? Financial advisors bring a certain amount of value. Some people aren't necessarily leveraging the full relationship value of an advisor, and so they're really not talking to that person much. If you can automate the rest of the stuff the advisor is doing for you at a much lower cost, that's what those platforms are doing a great job of.